All right. Hello, everyone. We're going to get started in a little bit. Um, and we are going to begin discussing what's about to happen in a very, very important meeting that we have coming up. Let me share this out into the world and let's begin talking. It is going to be quite an interesting meeting. Um, Most likely going to be most likely going to be 75. That's probably what we're going to get. We're going to get 75. And I think the market's getting ready for it. The market's been rallying all morning. So we've been basically excited to get to 75. And I think the market has baked it in. Now, if we get a surprise 100, that's going to be a different question. But I don't know if we're going to get that. Nate, what's up? Live FOMC meeting. Let me tweet that out. Let's look at the markets right now and see how they're doing. Been pretty good all day, to be honest. Palantir is doing phenomenally. Obviously, the news yesterday, I think the market definitely appreciated. But we're going to see sort of where things are and how they are being positioned. Powell's going to speak probably for about an hour and then also have questions as well. There's going to be a lot of people asking him a lot of specific questions on how he perceives the market to be in this current macro, and if there's going to be more pain that needs to be done. And I think that's going to be the interesting to look out for is like how hawkish does the guy sound versus how excited does he sound about what's going on. NVIDIA recovering pretty nicely today at 136. It was at 132. It did it had their conference today. Their developer, basically their worldwide developers conference, right? The thing that they do. And it was pretty exciting. Some of the products that they've shown off. Palantir at 796, doing absolutely phenomenal today, 4.4% up. Ginkgo Bioworks was up 3%. It was up at 309 at one point. Spotify down a little bit, 97. Google 102. Ford 1343. Meta still not recovering as well. Lows of 144. Now it's at 146. Oh, it hit 143. Hit 143 today as well. Richard, what's up? I'm here. What's Mr. Powell say? We don't know. We will find out very soon what Mr. Powell is actually trying to say. NVIDIA 136. Tesla 309. Look, I think we are in for a bit of a rally if we get 75 because the market is baked in 75. It's pretty obvious at this point. And the market baking in 75 means that we are unlikely, I think, to see something that's different from that. Unlikely to see anything different from that. I mean, if we did see something different from that, it would be, I don't know, it would be a bit weird from the Fed. Now, if they wanted to do 100 and rip things off, the market's going to tank. But I think the market would also appreciate it at some level, which means they might not tank because we kind of do need 100. I'd say it's almost guaranteed we get a 75. Yeah, I agree. All right, before it starts, let's see what the talking heads are speaking about. And let's see how they are discussing some of the core things. Also, the big bank CEOs are being testified today, which is interesting. Did not know that was doing. Okay, let's hear. This is some of the macro stuff we got going on right now. If we get 75, we regale. If we get 100, we tank. I agree. I absolutely agree.
I'm coming to you first. So you have an idea of what's going to happen today. This move in the 2-year to 4% for the first time since 2007. Stocks hanging in. What's the message there?
Yeah, stocks are hanging in, but I can't remember a time since the great financial crisis when the bond market has been so important as an indicator of where equities ultimately going to go. Now, if you've got that 2-year after the Federal Reserve statement today and press conference, and it's pricing above 4%, that's going to act as a headwind for equities to ultimately have a rally. I think the 2-year, without question, is going to be the leading indicator. I think the press conference today, as Steve spoke about, is critical. Is the chairman going to maintain the same disposition of a very hawkish, terse statement that's going to be released before that? if there's any degree of flexibility, if there's any degree of comfort, if there's any degree of leaning towards that the terminal rate's going to be 4 to 4.25%, Scott, the market isn't positioned for that, and that's where you're going to get the rally. The market right now is overwhelmingly positioned bearishly. It's reflected in all of the CFTC data, which shows that holdings of S&P futures are at their most bearish level since 08, since 11, and since 2015. And you know what happened in each of those three instances. So the press conference, to me, absolutely going to be critical.
Unless, Bryn, you think the market's getting a little too aggressive, right? We just talked to Leishman, 453 in April of 2023. Maybe he says they go 100 more this year. And then in his words, you know, look around, stop and look around. How do you see things heading into the meeting a couple hours time?
Two things. First of all, on the 2-year, if investors want to tell, going back for a very long time, when the 2-year not only stops rising, but starts falling, and usually around 50 basis points, that has been a very, very good indication of where the terminal rate and the Fed funds rate will be. So right now we're going in the wrong direction, but watch for that over the next, 3 to 6 months. I think that what Steve said with his three H's are spot on. I think the bias after the Fed speaks today is actually to the upside. I do agree with Joe. There's so much negativity right now. And so I'm not even remotely calling for some long-term rally, but I don't know how much more hawkish Powell could get besides already using words like pain. And so I think if he just continues with the same narrative, I don't think it will be any surprise. And I do think you could have a relief if he doesn't go even more hawkish than his pain trade. So I think there's a little bit of a bias after he speaks to the upside later on today.
Yeah, it's like you wrote the headline of the Wolf Research note today, Bryn, because that's what they're talking about. Our sense is that the markets could be set up for a short-lived relief rally if the Fed hikes by 75 and Powell doesn't ratchet up his hawkish rhetoric even further.
So it looks like that's basically what's going to happen, right? It looks like it's overwhelmingly bearishly positioned, and we're going to see how the 75 attracts it. Gabe, thank you for being here. Happy you're here. A lot of YouTubers are live. You're my guy, though. I appreciate you guys. There's a lot. Oh my gosh, the mic was so bad. Hold on. What audio have we been using? I hope. Oh wow. All right, is this audio better? This audio should be way better. The mic was so off. Let me make sure it sounds good. Okay, it's better now. I was going to say, yes, thank you for being here. I know there's a lot of YouTubers that are live, so I appreciate everyone who showed up to mine. BTW, I'm loving all. Dia, thank you so much, Niels. Appreciate that. Link in the description for anyone who wants to check it out. Gabe, thank you for being here. Damien, how'd the meeting go? Meeting went very well. I'll tell you guys more on late night stock talks tonight. So ultimately, the market is positioning for that 75, and it is bearishly positioned if we are to get out of it. And we are going to see how that happens. So let's finish up this, and then we'll move on.
Further. Jason Snipe, your expectations here?
Yeah, absolutely, Scott. I think, for me, it's all about the rhetoric. Joe just mentioned that. I think the commentary is going to be key. Obviously, the 75 basis point move is priced into the market. I think, and the other piece is higher for longer. How long? How high? Obviously, what will the terminal rate be? Anywhere between 4.25 and 4.5 is obviously starting to get priced into the market. So for me, the market's going to be hanging on to every word that comes out in the presser today. And I think I agree with Brent. I think there might be a bias to the upside, but I think he's going to be terse, brief, and get right to the point because credibility still remains on the line.
Yeah. Sarat?
All right, let's see how the markets are doing. The meeting's going to start in about 4 minutes. So it's so crazy, guys. I just want everyone to take a moment and think about it. We all have our lives, and we are here listening to this guy that we have no control over speak for the next hour and a half, and we're going to listen to every word this dude says. Like, it's going to be so interesting. Echoes, shout out to you being here, bro. They're literally saying the obvious. Yeah, well, CNBC, you got to remember they're a media company. They got to make media. Media business is tough. And you know this, Echoes. You're trying to find content every day. All of us are trying to find content. So, yeah, a lot of times CNBC is just going to be saying the same old stuff, but that's what they do. Market always rallies on FOMC. It's literally done that. Well, there was one time it didn't. There was one time, this was in February. I remember this because Meet Kevin bought in like and he wasn't supposed to buy in, and the market tanked on. I think it's because they did 75 over 50 in February. I might be getting this wrong, but yeah, they usually tend to rally, and I think that's what we've seen this morning. So Ford, by the way, it was down 12% yesterday, recovering about 3%. Spotify 97, DNA 304. Where's Palantir? Palantir looks like it might break 8. Doing pretty well today. For those who have Palantir in your portfolio, it's a nice green day, which we deserve. I think I bought like $400 or $500 worth of Palantir at 760 or something a week ago. So I was seeing that. Clean Spark up 0.25%. Zoom 77. SoFi under 6, but up a little bit, 590. Apple recovering a bit at 157. Google up. So the market in general is green. As soon as Powell talks, we're going to see these literally in real time go up or down. There was no FOMC in Feb. It was either January, maybe March. But I remember there was one time where it just tanked based on it. But I guess we will see how that plays out. Let me type in FOMC live on YouTube. And we're going to see. Oh, here it is. Okay, so it's going to start right here. I got it loaded up. Hit the like button. Felicia, thank you. Yes, if you guys could all like it, would mean the world to me. It would be super awesome. Ibrahim says, who is this Echoes fool? Echoes is a friend of the channel. So let's all be nice to each other in the chat. The chat usually is nice to each other. Echoes is a pretty dope guy. So he's not a fool. He's a cool guy. I'd rather be here listening to you explain FOMC instead of going to meet Kevin. I hate him marketing this shit real estate. Look, guys, everyone has their own thing. First of all, 115 people here. Thank you so much for being here. Really appreciate it. You guys could choose to watch anyone. You're choosing to watch me and watch my analysis. Look, everyone has, I think me, Kevin, has 21,000 people watching him. He's built the audience. At the end of the day, you got an audience. You got 21,000 people that care. They care. So it's just, it's all your cup of tea at the end of the day. And it's also scale, right? When you have 1.8 million subscribers, you can get 21,000 people to show up to something, right? I have 14,000 subscribers, so it's harder to get 21,000 people because 21,000 people don't even subscribe to me. That's just how it works. But you show up no matter what, whether it's 122 people or 12 people, and you do your job. And if you love doing it, you do it, and you do whatever you can do. Amit is legit. Appreciate you listening while driving home. Awesome. Amit, you got Instagram? Yes, at It's Amit Karaja. I'll just put it in the thing. Instagram just, it's Instagram. But whatever. Okay, let's see. They should be going live very soon. Wait, is this at 2:30 it's going to go live or 2 p.m. it's going to go live? Why did it say 2:30? I read somewhere else at 2 it goes live. It goes live at 2, right? But I think 2:30 is when he takes questions. I don't think I'm wrong on this. Okay, yeah, it's probably going to start here. Yeah. He's doing an ad. All right, so as soon as it starts, we'll begin. 2:30 is when he speaks. 2 p.m. is when they release minutes. Okay, got you. In one of your previous live streams, I asked you why you don't invest in Indian markets. Few months have passed and Nifty 50 is at all-time high while S&P is down massive from its highs. Well, I don't invest in Indian markets because it's kind of hard to invest in Indian markets, Dr. Sahil. It's just complicated for me to go out of my way to do that. Fed raises rates by another 3/4. Okay, there we go. Fed raises rates by 3/4. We got the news. There we go. I actually thought the meeting was going to start at 2, so I'm sorry about that. The meeting started at 2:30. We got the minutes. Here we go. What's going on in the market? What's going on? What's the Spotify down to 96? Google just hit a new 52-week all-time low, 100. Rumble down. Meta, 144. It's close to the all-time low. Open Door. Goodness gracious. Who's an Open Door? Be honest about it, because this stock is getting demolished. And you can't be scared to say you're an Open Door. You gotta take the loss on the chin. But sheesh. Open Door. Ginkgo 29. I want Ginkgo to be at 250. Please give me 2. I will buy the crap out of Ginkgo at 250. So let's get it down further. Let's look at the overall markets. Yeah, it's red. It's red. But it's weird. I feel like we're gonna rally right off top of this because we baked in 75. Everyone knew it was gonna be 75. Tesla's down barely anything. It was 309 now to 307. That's nothing. Nvidia 134 doing okay. Where's the S&P? I think we're gonna be at 383. 384. Damn, I'm there at 383. I was so close. 383 on the S&P. Where's the NASDAQ? I think we're at like what, 10K on this, 11.5, 11.4. Okay, 11.4 on the NASDAQ. This is normal. Market always drops first, and once Powell speaks, it goes back up. That's probably what's going to happen here. Probably overreaction. It's all about what Powell says. What's the rate hike? 0.75. 0.75 is the rate hike. They expect to raise 50 in November and 25 in December. Is that what they said? Let me pull up the official release. Let's read that together. Let's read that together. Wow. Interesting. Let me tweet as well. 0.75 bips. 0.75 bips. Bips. Let's rate hike. 0.75. You know, it's so crazy. Years ago, I would have never cared about this, and now I care so much about this. All right, so, and that's cool. Things change, but it's so interesting now that, you know, you care about this. All right, let's look at this tweet right here. This is going to give us some decent information. So we got Fed raises by 75 bips to a target range of 3 to 3.25% by the end of the year. Officials see Fed funds reaching 4.4 at year end, suggesting one more 75. So some people think another 75 before peaking at 4.6 in 23. Unemployment set to rise at 4.4 with growth slowing. Core inflation still not at 2%. That's the target in 2025. So this is what we're looking at here. So the range here, the federal funds rate range, it's looking at 4.4 by 2023, 4.6 by 2023, coming down to 3.9 2024, coming down to 2.9 2025. So if that's the case, that's going to be the time where markets start to rally, theoretically 24, 2025, if inflation doesn't go down by 2023 and we still have high interest rates. And then that's going to be lowering down as we go down. So so the Fed wants to get to 2.9 on the interest rates by 2025 or 2.5. But we need to get to 4.6 in 2023. Now that would lead inflation to, as you can see right here, 4.4 at a high, and eventually would get a little bit lower by 4.3. So that's kind of what the Fed is asking for. 175 or 15 and 25, same thing. Pounds are unaffected finally. Yeah, finally. Can you tell me what they mean exactly by wanting to get you a soft landing? That's a good question, Sasky. So a soft landing is basically, let's not cause a recession, but let's still get to what we need to get to. So what does the Fed need to get to? They need to get to two things. Number one, they need to get to interest rates they need to get to inflation coming down below 5%. I mean, 2% is their main target, but they need to get below 5%. If they can get below 5% on interest rates, they're going to be in a really, really good position, right? And in order to do that, they need to, 5% on inflation. In order to do that, they need to raise interest rates without crashing the economy. A hard landing is when you have the NASDAQ fall another 30%, the S&P down 19% year over year. It's down 33% year over year, 34%. That means you have crashed the economy, you have induced a recession, you have created massive levels of layoffs in order to contract the economy, which means they're doing quantitative tightening. They're taking $95 billion off of the balance sheets every single month, and they're raising interest rates to compress valuations so that the stock market crashes, so that inflation gets down to normal. If you're in the Cathie Wood, Elon Musk type, you're saying, look, inflation is already going to normal. You don't need to do that. And obviously they're saying that because if the Fed does that, that hurts growth stocks the most because they're valued on future cash flows. And obviously if interest rates are higher and the capital is hard to borrow, then those future cash flows get discounted, which is not good for growth stocks, right? This is what we've seen in the market. S&P 380, S&P falling from 383 to 381. So a soft landing is, how do we raise interest rates without crashing the economy? So the economy may go down, we might get to 360 on the S&P June lows, but we don't get to the point where we're at 300 on the S&P. We're not at a 2008 level. We're not at a 2001 level, even a March 2020 COVID level. And the question is going to be if they're able to actually do that. Market testing yesterday's lows. Yep. Stocks falling. Market just broke yesterday's lows. It did. We have broken yesterday's lows. It's interesting. Google, look at this. Google's 46 cents away from going under 90 or going under 100. Oh, Google's cutting staff. Wow. Google's cutting staff. News update just came out. Google is cutting staff. See, and this is what the Fed wants. They kind of want to induce a pseudo recession because that will calm the market. They do not want the market to. That's why the Fed and the market are always arguing against each other, because the market wants to go up. Why? Because it's the market. The Fed wants the market to stop because the Fed has a ton of other things that they're doing. As in the Fed is the Fed is trying to get inflation under control, right? So they don't want the market to rally. So there's always this push and pull with the Fed and the market. And if Google's laying off people, the Fed is happy because that means there's less money going into the economy, less inflation, right? That means less demand, all that stuff. Now, is that good for Google employees? No. So that's what it means. Like, how do you manufacture a landing that doesn't hurt everybody, or has the least amount of potential things that would happen? Meta and Google both announced layoffs. Let me Google this real quick. Google layoffs. Yeah, right here, the Wall Street Journal. Let me look at this. I don't know if this article is paid for or not, but let's share this. Let's share this right here. Meta and Google are cutting staff. Just don't mention layoff. Okay, oh, we got it. We got it for free. Okay. In a response to stalling growth and intense competition, Meta Platforms executives have spoken of cutting costs. Meta has begun quietly nudging out a significant number of staffers by reorganizing departments and giving affected employees limited window to apply for other roles. The reductions are expected to prelude deeper cuts. Meta looks to trim at least 10% within the next few months. Wow. Meta has like 80,000 employees. Hold on, let me look up Meta's employees right now. On Robinhood, it's actually really easy to find it. Meta has 71,000 employees. So that would be 7,000 employees they would cut theoretically if they were to just atch it. If they were to get rid of it. Wow. Very, very interesting. And then Google, they have 83,000 employees. Sorry, that number is down. So that would be 8,000 employees if they get rid of 10. Google has also required some employees to apply for new jobs. Google typically gives employees 60 days to apply. In March, more than 1,400 Google workers signed a petition demanding the company extend the 60 to 180 days. Yeah, so I mean, when this is happening, it means companies are preparing for a macro headwind that's going to not be nice. And the question is, how bad does it ultimately become? That is going to be the question. ARK may dip under 40. Where's ARK right now? Let's look at ARK. ARK is 41. ARK got to 35 at 37 a while ago. This is back in June and May is when the market really was scared. And right now, we're not having that level of fear in the market. DNA already bouncing back up. Let me check DNA real quick. I bought a little bit today already, 296. Might buy some more. AMD hit a buy order on the dip. Let's look at AMD. NVIDIA had their big event today, which they showed off like some supercomputer thing. So NVIDIA bulls definitely got a kick out of that. Let's go to AMD. Then let's hear what CNBC is saying. 75. Okay, so AMD is 275. All right, let's go to CNBC. Let's see if they're reacting immediately to this, and then we're gonna get into the meeting in a little bit. I wanted 100 for maximum chaos. Showcat just like does not care. He's like, he's like the Joker, right? He's like, let's just ruin everything. Cause mayhem. Let's see Yahoo Finance. Let's see if they're talking about any of this stuff. All right, let's go to their coverage right now and see what they're saying. All right, let's go here.
And critically signaling that they expect the funds rate will stay high, maybe even move a bit higher next year as well. So persistently tight policy here through the next year and a half. So it was a little more aggressive, I think, than expected. The unemployment rate a little bit higher projected from the Fed than I had anticipated. So they are signaling they are serious about this. Critically, though, if you look next year with a 4.6% Fed funds rate they're projecting, they're also expecting inflation will moderate. The PCE deflator, their preferred measure, down to 2.6%. That means next year, their funds rate will be outpacing inflation finally. They will be sufficiently restrictive.
And a lot of people wondering what this means in terms of GDP projections that are out now. What's your take on what we can expect, and given some of the pressures that the Fed both can and cannot control?
Yeah, so it was expected that they would bring down the GDP forecast for this year down close to zero, which they did. By the way they measure it, they look at fourth quarter to fourth quarter growth rates. Last year's fourth quarter was extremely strong. Since then, the economy has been a bit treading water, as we know. So if you compare fourth quarter of this year to last year, it's going to look about flat. But underneath that, underlying that, I think the household sector in aggregate is still in really good shape. We know that their balance sheets in aggregate are good. And corporates, critically, businesses, profits have been more resilient, margins more resilient than expected. Companies have been willing to continue to spend, hiring, investing.
That's when the Fed announced right there. So as you can see, it was right at the top and then right all the way down, recovered a little bit and still going down. Whatever Jay Powell says is going to influence it even a bit more based upon what we see kind of happen. I'm thinking of buying a little bit right now. I want to go on a little bit of shopping. I want to do a little bit of shopping right now. I want to buy before Jay Powell speaks. Not a lot, just a little. Let's do a little bit of buying. All right, so here's what we're gonna do. Let's share my Robinhood. We're gonna buy some stuff right now. I'm gonna buy 3 positions that I want to buy a bit more on. So we have, as you can see, I have about $2,000 of buying power here. Let's put in 3. We're gonna spend 1,000. So we'll do 300 of DNA. That's 100 shares. You order buy. You guys can see this, right? Buy. Okay. Boom. Let's do $300. Do 100 shares of DNA. All right. So we got DNA, and then Goog. Let's do a little bit of Goog. We are at 100. I want to get it under 100. It's like right there. I'm just thinking like, let's just buy it now. Goog. There we go. It was just under 100. There we go. Let's do screw it. All right, let's do 200 of Goog. We'll save that extra 100 just for when it gets below 99. Do I get it below 99 or do I get it right at 100? I got it at $100. I got it at 99.94. Okay, got it at 99.94. Not bad. And then let's get some SoFi. SoFi is getting crushed. Let's get a little bit more SoFi. SoFi is taking this beating on the chin. Let's do 200 of SoFi. Let's do 34 more shares of SoFi. I would buy Palantir, but I think Palantir is having a green day, so it kind of doesn't make sense to buy Palantir today. Done. All right, so we did a little bit of buying before the Fed meeting. Let's see kind of how they play things out. Let's go back into the markets, see what they're saying. We'll go here. LOL, don't fight the Fed or Gabe. Don't fight the Fed. Can't win. We are 15 minutes away from Jay Powell. You know when he talks, he's so like, it almost sounds like he doesn't want to say anything that's wrong. He speaks so carefully because whatever this dude moves mountains, bro. Like hundreds of billions of dollars move on what this dude says. Spotify's down to 95. If we're going to analyze Spotify a little bit, they just unveiled their audiobook offering. And let me actually show it to you guys. Are you watching him speak live? Yes, I'll be watching him speak live. Let's open up Spotify. Their audiobook offering is a little bit weird to me, to be honest, as I started going through it, because they're just like selling books. And selling books, I don't think is the business that really accelerates them per se. It's the discovery of content, a new audiobook author, right? So if I type in audiobook, here it is, it's right there. I type in audiobooks on Spotify. This is a podcast I listen to, Plenty in 20. Don't judge me for listening to a podcast called Plenty in 20. I'm like their only listener too, bro. It's so sad. Okay, here we go. Audiobooks. So this is their offering, right? So if I want to buy Atomic Habits, $18.49. I have to buy it right there. To me, this is the wrong approach. I think this is an archaic model. I mean, Audible has already done this. Amazon does this. It's not that you can't compete with Audible. It's just that I would think if I'm a new audiobook author, could I put my content on Spotify and have it get discovered and find people to potentially buy or listen to my book? If I'm James Clear with the most famous book on the planet, Atomic Habits, Spotify is just another place for people to buy it. It's not a level of growth. Now, the bulls may say, okay, well, if you pay $18 on Spotify and they take, I don't know, what's the commission? Let's say 10%. It's probably lower than that. But it's probably much lower than that, maybe 2-3%. Then they have this like new stream of revenue. I guess it's just a question of why would people buy the audiobooks? Now, there's no reason people wouldn't buy the audiobooks on Spotify. To me, it's just not this whole new form of user-generated content where aspiring audiobook authors look to post their content on Spotify because they think it'll get them discovered. I think if you solve that problem, that's a multi-$100 billion market that's way bigger than selling the same audiobooks that you could get anywhere else on Spotify. And I don't think the market was impressed by this as well. I mean, they just introduced this and the market really did not care too much about it. So yeah, it's not the most interesting route to me in terms of growth. I love Audible, so much learning. 2 books a month is not enough, so I usually buy 3 extra credits a month. Yeah, and Audible is cool. And I mean, I guess you could do the same thing, but Audible also, correct me if I'm wrong, Blake, you pay $15 a month and then you have to pay money to buy books. Is that how it works? Like you pay $15 for the month and then you have to pay to actually buy the book, right? Or do you get credits from that 15? S&P 381 stayed pretty basic. Nothing changed. Bought Google a few seconds ago. Let me tweet what I just purchased. Let's tweet that. By the way, if you guys aren't following me on Twitter, you should follow me on Twitter. Bought SoFi DNA Goog. At Amid is investing. So that's what we've got there. There's nothing that interesting going on. 241 on Microsoft. Rumble, that's the conservative YouTube SPAC that launched. I would stay away from it. I don't see them as it's hard to understand what they're really trying to. They need to grow their user base, to be honest. They have 7 million downloads, which is cool. But they did 4 million in revenue last year. And I don't know, it's not that interesting to me. But I mean, if they can attract the conservatives of the world, then you've got something there. Adobe, look at this. Adobe going under 290. Oh my gosh, man. The market hated that deal. Absolutely hated that deal. The market was just like, that's a horrible deal buying Figma for $20 billion. I think it was a great deal. And Adobe seems to be on sale. Now, I'm not going to buy Adobe because I don't care that much about Adobe, but not bad. Tesla falling, 306. 309 went to 306. But you got to give Tesla credit, man. They have figured out how to survive. They've just kept going. They've been so resilient getting through everything. And they've just kept it going. Yeah, you get 2 credits, I think, for 20 or so. They usually like to buy 3 credits at a discount for like 35. Gotcha. Very interesting. Very, very, very interesting. All right, so we are 10 minutes away from Jerome speaking. And he's going to be arguing why they needed to do 75. You're going to get the first 10 minutes of him basically saying why they needed to do this. And then the rest is going to come on the logic of how they're going further. All right, let's hear this. The Fed is keen on front-loading rate hikes. Let's see this here.
Roger Rajappa, head of U.S. rate strategy at Societe Generale. Stephen, I'll start with you. I'm not dunking on the Fed, okay? They're much smarter than I am. I could never do their job. It's hard. A lot of variables.
Great observation you just made.
Yeah, I'm just pointing out that what they said was going to be happening right now, 1 year ago, couldn't have been more off.
But that's exactly it. Again, what we will be thinking about the economy at this time next year is going to be very different. Where we were a year ago, exactly right. Where the Fed was in 2019, expecting to go further, expecting QT to continue. All of these things. We just have to realize that if you go in 75 basis point increments, you're delivering, as they will today, the equivalent of a full year of monetary tightening in the space of 4 months. If you simply over-medicate the patient and don't wait for the notion of how long it takes for this dose to get through to the economy, you are at risk of creating more damage than you intend. And it's in next year's economy, next year's inflation rate that we'll see that. We could definitely give you some points and show exactly what is happening on a forward-looking basis that is not obvious today.
So, Badger, I'm going to trust you, I think, more than the Federal Reserve on rates. Where do you see interest rates 1 year from now?
That's, of course, a very hard question to answer, given how, as you pointed out, just a year ago, 2-year yields were around 20 basis points last year this time. So we're looking at just a precipitous rise in yields. But I think I agree with the premise that Steve was laying out earlier, which is that I think that the Fed is definitely keen on front-loading rate hikes, getting rates to perhaps 4% by the end of the year, maybe peak Fed funds rate at 4.5%. But broadly speaking, I think that, as we all know, policy works with long and variable lags. So they're eager to get rates out to 4% and beyond, but they're going to really need to see the impact, broadly speaking, of higher policy rates. And you're already starting to see that somewhat in employment is strong, but then you're starting to hear of headlines of people laying off workers. You're also seeing that on other metrics. On the earnings, I'm sorry, on the forward guidance from the FedExes of the world. So there's still there's definitely some slowing down in some of the metrics, but again, it's too early. The economy is still pretty strong. The trajectory for rates is probably higher over the near term.
Would you agree with that, Stephen? Probably higher.
I think it is. It's the way they've operated. Again, probably moving up rapidly will mean that we will not sustain as higher rates as we would get if they were going gradually, if they were allowing the economy to adjust to it. Whether that's good news or bad news for you, that's to consider. But I just given a concrete example for everyone. We have had the monthly pace of new home sales from the end of 2020 to now. It's fallen 51%. What are construction outlays? What are housing completions? -2%. Why? Because it takes 6 to 12 months to plan and build a house. The construction pace is based on where interest rates were, what the sales pace was when it was higher and rates lower. Construction employment is at an all-time high trying to complete these houses. We're going to see very large, probably double-digit drops in construction-related employment in the coming year. And it's pretty obvious, and this is going to spread more broadly to the economy. It's just the easier example of interest rate sensitivity.
Okay, I want to just play one more clip before we get into the meeting, and it's talking about Meta. Someone just tweeted me, what if the Fed just raises it to 5% right now? Because I said they're trying to get to 4.6% by 2023, and so I was like, why can't we do 5% right now? That would, the market wouldn't like that if we did that. Someone asked me about Blake asked me about Adam Levine. I don't care too much about the controversy. I mean, the dude does, it's more TMZ type of drama stuff. It is what it is, but I care about the Fed right now. All right, let's hear about Meta, and then we're going to get into the Fed meeting.
What's your read of this news? It is causing the stock to rise.
Look, I think Facebook came out with these huge expectations of growth in terms of how much we're going to spend, billions of dollars into the Meta. And I think this is a good thing. It's reining in costs is really important as we go into, potential advertising slowdown as well. So to me, it looks like the company's making the right moves here, cutting costs and focusing, on operational, expertise. So I think it's good. They have to deliver. It's been an ugly stock. It's been one of our worst performers. But I do believe there's a lot of value there, and I'm still a holder and a buyer at these levels.
See, Bryn, I can think of, reining in costs is one thing. Reining in costs when you need to spend for what you've determined the future of your company to be. You've sold investors on that vision, and it is a long-term vision. So if you're reining in costs now, does it prolong the runway of getting to your vision?
Right. I mean, I've told you before, I'm more of a tourist in this stock. I bought it probably 30 points ago. And it's been like, this is a textbook to me, growth name that's become a value trap, right? I got sucked into it, right? The stock had a low PE, and now the PE's, I want to say, a 15 times forward. It just continues to go lower. And so how can they continue to spend $10 billion a year for this metaverse? I have air quotes here, metaverse, yet reining in costs. So I agree with you. I'm more looking as year end, as the year end comes, whether I'll do like tax loss selling on this, because it's just been such a poor performer. Even when tech rallies, it just doesn't rally. And so I just think you need to have a total resetting of the table with expectations to get investors to come back to this name. Otherwise, I think it's going to be a growth value trap, which are just painful to own because you don't want to miss that move if you do see tech starting to turn around and you don't get it here. That's such a shame.
Yeah, it makes sense. I mean, Meta's, that's why I haven't picked up Meta. I love Meta. I love Meta at 325, unfortunately. But I haven't been able to get back into them because it's just been scary, man. What she said about a growth value trap, I think, makes so much sense to me. Question is if they're able to, to keep it going from there. Okay, so we are a couple minutes away. Let's take one last look at the market before we'll be looking at the market as well when Jay Powell speaks, but he's going to speak in 2 minutes. So far, it's down, but it's not that bad. Let's take a look. S&P's 381, NASDAQ 11,355. Okay, so not too bad. Palantir 782. If Jay Powell says anything like inflation's not going down as much as we thought, or it's bad, then we might see this. I think we could see the SPY get below 380 pretty quickly if the market doesn't like what's going on. There are hundreds of thousands of computers across the country, across the world right now, trading for like pennies of a penny, fractions of pennies, to be able to make millions of dollars off of the upside or downside of what Jay Powell says. Literally, that's happening, whether you're watching this at home, whether you're at work, whether you're just chilling around and you have this watching. At this moment in time, when Jay Powell speaks, lots of money is going to exchange hands. Meta, by the way, at 144, to figure out what's actually going on in this market. It's going to be very interesting to see how this kind of plays out. So let's get into it. It should be starting very soon. Probably about 30 seconds away from it officially starting. And I'll be here. I'll be live tweeting it as well. So if you guys follow me on Twitter, I'll be tweeting out all the updates as well. And Facebook should have changed the name to Zucks instead of Meta. That would have been an interesting business name. Google at 100. Yep, I picked up a little bit of Google. It should go below 100, to be honest. It should easily go below 100. So we are going to see it. Should have named it to Zuck and went in the zucchini business. Oh, goodness. Is that a better business than the metaverse? The metaverse. All right, we're starting. I'll see you guys on Twitter live tweeting it, and I'll pop in a little bit if I hear something interesting.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal. A sustained period of below-trend growth. And there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, real quick, we're gonna take a quick break, and we're just gonna look at the market right now because it is mooning just like 30 seconds. It was nice to buy a little bit before this all happened. We have Ginkgo Bioworks up at 306, AMD 76, Tesla 309, back to where it was in the morning. Palantir 790, back to trying to get back to $8. SPY 384, Beyond, Spotify, everything. So market's going back up. Let's see what else Powell has to say. The markets are going back up.
Hi, Chair Powell.
Committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether Also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation.
Very interesting. He just said the chances of a soft landing are diminishing as policy changes. He also said we don't know if there's going to be a recession or not. Google is up. If you bought at 100, you're probably happy. Palantir is up at 805, crossed the 8 mark. The market's rallying on this.
Back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that, I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings. And you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve. And that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And
it seems like he's not ruling out 75 again. Based on his answer to that question, he's not ruling it out.
That's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue front-loading right now? Is it a lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is.
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation. And that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. but we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike,
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't.
This is a very important question. He's basically saying, how do you know if it's time to stop, or how do you know if you're going to keep going?
I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth. And we're seeing that now. So the median forecast, I think this year for among my colleagues and me was 0.2% growth. So that's very slow growth. And then below trend next year, I think the median was 1.2, also well below. So that's a slower, that's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, and if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability. And I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Basically, Powell is saying, look, man, I'm trying to do the best. We got to get inflation under control. We got to keep raising. He's not answering the question of how do you know you're going too far. He's simply saying, I'm trying to do the best of what I can do. Let's look at the market really quick, and then we'll get back into it. Market's rallying pretty nicely. It's not that bad, actually. Here we go. So we got Tesla at 312, just doing phenomenal. DNA hitting 309, AMD 77. Opendoor is not getting any love, but it's Opendoor. 387 on S&P. Palantir up 5.28% at 802. We have broken $8 on Palantir. Spotify up at 98. Google 102. Adobe even recovering from 289. So, I mean, overall, the market baked into 75 and they're rallying on it. The question is if this can continue. And Powell hasn't said anything that has kind of pissed off the market since we've started. Let's get back to Jerome. Where is he at? Okay, here we go.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market. As you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can pick, and but what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right, there it is. It's over. It is over. Let's take a look at the markets. The markets are starting to tank. We had a nice little rally, and that just went to crap. So let's open it up. Webull, here we go. Tesla is still doing well. I mean, at 3010, Ginkgo 306 was at 315 at one point. ARK 41, S&P 385, Palantir 790. Oh well, the market's rallying a little bit. It was just at 790. Okay, so we're starting to go up a little bit. Overall, I mean, it's nothing. He didn't say anything that shocked the market from my perspective. He didn't say anything that was different. Now, some of the points he made upon labor is interesting, right? So basically, Jerome is saying there's too many people there's too many jobs and there's not enough people looking for the jobs. So he's like, we've got 11 million jobs or whatever it is, and you've got like a couple million people to fill that. That is going to cause wage price spirals because employers are going to have to compete with each other, which means they're going to have to raise prices in order to get the best talent. That's great for employees. That's great for the labor market. The problem is that's not good for the actual market because when you've got, prices going up, that doesn't help when it comes to inflation or wages going up. What needs to happen is, he said, a cooling between the supply and demand of the labor market, which means the labor market has to have less people looking for a job than there are jobs opening, so we don't have that kind of cooling. That means you need to have layoffs, right? And he kind of subtly said people need to lose their jobs. And the way he said it was that the unemployment rate needs to go up to about 4.4%, because when that happens, that's about 1.3 million jobs. That leads to less competition for wages, which means people can get more jobs but at reduced prices, which overall helps the macro and helps inflation go down as well. Now, that's going to be tricky to see how it actually comes out. We know Google, Facebook are laying off some people. We know there's more layoffs coming. But overall, to be able to allow that level of, decrease in the market, in the labor force is going to be interesting to see how they get it done. And obviously, if they keep raising rates, companies have no choice but to at least, not hire people or lay off people. And, that's when you lead to a lot of these different things that are happening. But there's still so many opportunities when it comes to jobs in general, which is why I think he's saying it could be like a soft landing for the labor market, which is what happened in 2018 through 2020, where the unemployment rate relatively, it went up, but the amount of unemployment didn't go up as much, even if the rate went up, because people were still able to find a job. Power market, power hour, does markets rally? Everything's green, as you can see. We've got a lot of green. So the market has pretty much took it on the chin. They're like, all right, we expected what was going to happen. We rallied up, we went down, we rallied up. And I guess now the market's going to try to figure out how they go from here. Well, now we got this out of the way. That's the biggest thing. It's out of the way. It's done. The question is, where does the market go from here? And I guess we'll find out. All right, that's it for me. Thank you, everybody, for joining. Got a couple more videos coming out a little bit later today. Check out the link in the description. Sign up for my startup, please. It's free. We're trying to change the way people discover audio. Would love any of your feedback on that. Late night stock talks tonight at around 10 p.m. I'll see everybody there. Thank you so much for joining with me. You guys had a lot of options to pick whose stream to join, and you joined mine, so I really appreciate it. I will see you guys later tonight. Bye, everybody.